Welcome to Officer 24/7. My name is Neharka Bhatnagar and I'm with you with the era of accounting and financial management. Acha, today what are we going to talk about? As you know, I've started with the module B. Now we are progressing further. Matlab, today's topic is going to be cash flow and fund flow. Along with this, I'll be starting with another topic that is banking companies, the financial statements of a banking company. Do you know? Uh, okay. We were talking about it in the last class even. In a banking company, or I would say in a bank, bank is basically a company, which is called a banking company there, right? So when we talk about banking companies, they follow Banking Regulation Act. Number one, they are following RBI Act. They have to follow Income Tax Act. And now parts of Companies Act are also applicable to them. Then they also have to face EPF Act, okay, gratuity, and many more allied acts are applicable on this particular uh, organization. Okay, so cash flow statement and fund flow statement. Cash flow is required. It is actually compulsory for all those companies which are covered under cash flow is compulsory for all those companies which are covered under listed. The companies which are basically listed under SEBI are required to get themselves prepared a cash flow statement. Okay, all the top-notch companies, they have to get themselves all these required documents. That means it includes profit and loss account, they include the balance sheet, then they include the cash flow statement as well. Okay, now comes the next pointer. What are we going to talk about today? Number one, I think when we look forward towards the entire topic that I'm going to cover today, first portion is going to be the financial statements of a banking company. And in the last class when I was covering the topic, I had covered more of cash flow statement and a bit of fund flow statement, right? So today it's gonna be a mix of all these. Let's move on and talk about it. The first question says, which one of the following is not considered to be subsidiary book in the bank? Current account ledger, general ledger, loan ledger, or bills discounted and purchased ledger. Subsidiary means an additional book. Bank also creates a few books and they call them subsidiary or additional. For them, the additional books that they're creating is general ledger. Okay? It is the general ledger. Okay. Here comes the next question. In case of financial statements of a bank, or we can say the banking company, it is defined schedules. That means first schedule as per this has to be the shares, then the second is defined, third is defined, fourth is defined. So all these have specific serial numbers according to which all these things are defined. Okay, and after the completion of the financial statements, that includes the balance sheet. After the balance sheet, now they have a particular term called contingent liabilities there. For that particular area, they have a schedule but no place in the balance sheet. It is placed at the footnote of the balance sheet. Okay? So in this case, the correct answer is going to be the schedule 10 of the banking balance sheet of a bank provides the details of what? Fixed assets, current assets, investments, or other assets. The schedule 10. Let me give you a hint. First 5, 6 are specifically for only and only for the liabilities, and these are for the assets. So when we talk about the schedule 10, the schedule 10 is for fixed assets. What are fixed assets, everyone? How do we define the term fixed assets? If I have to define the term fixed assets, it's going to be like the assets which are divided into two broad categories. One is tangible, one is intangible. In terms of tangible, we would include the ones which can be touched, and the ones which cannot be touched are called intangible in nature. Fixed assets are those assets which are used for more than 1 year. Next question. Rebate on bills discounted refers to. Acha, what do you mean by bill discounted, everyone? What's the situation there? Okay. Sometimes people come to bank and sell their bills receivable. What do you mean by bills receivable? Bill receivable is an asset. I have got a particular right to receive money from certain person. Okay, now that's a right that I have got. That's an asset for me. That pata I'll get money from so and so. So that is my asset. Suddenly, overall, it was for 3 months. Suddenly, I had to make a major payment and I decided to sell off this bill receivable. And I went to the bank. And said that, bank, as such, 3 months are left to get the money from my person there, from the person who is supposed to pay me. The bill is accepted. I have got all the statements, documents, whatever is required. I've got everything. The bank said, okay, if the bill is for rupees 10,000 and 3 months are left, okay, I handed over the bill to the bank. How much money will the bank give to me? The first and the foremost question. The point is, this bill would be held if it would have been held by me. Technically, I would have got interest. It is. See, if I hold a particular bill for a certain period of time, there is an interest involved. The bank will say, if I buy the bill for 10,000 and collect 10,000 from that particular person, what am I getting? What is it that the bank is getting? If I don't make money, how will I give money to others? There are so many people who are dependent upon banks, be it the bankers, be it so many other people there. You know, that doesn't make sense. So as soon as the bank said it, I was like, no, the bank is right. What I can do is 9,500 rupees. Bank gave me 9,500. After 3 months, bank will go to the particular person and will buy it. Now, then what is it? Then the bill discounted means the discount that the bank gives us. You know? That is the amount of discount that the bank gives us, because ultimately bank has to earn from that. Again, now the point is, sometimes what happens is, bank, I gave one of my bills to the bank. I gave a bill receivable to the bank for collection. Sorry, payment. I went to the bank. There was a bills payable. I had to pay to someone. Bank made the payment for me in advance. I was supposed to pay on 31st of March, and I got a little money in the bank. So then what had happened is, instead of 31st of March, somehow the payment through the bank cleared on maybe a month before, maybe a little earlier, just because the payment is made earlier. Now I am eligible for discount. You know? Since I made the payment earlier, the interest portion should be reduced, and it has to be. So in this case, I receive income because I make the payment before time, and that is through the bank. So there are different kinds of bills receivables and bills payables, and banks also make money through this. Maybe through the particular person's, the payment that they are making for the person, and maybe through the bills that the person would have sold them. So in this case, they are saying that rebate on bill discounted is concessional rate of discount for priority sector, rebate provided to priority sector or unexpired discount or none of the above. Rebates on bill discounted. At this point of time, if there's a rebate on bill discounted, rebate means it's a kind of less money to be paid by the particular person there. This is basically called unexpired discount. The discount is yet to become due. Okay? It's called unexpired discount. Next point, the operating expenses shown in one of the schedules of the profit and loss account of the bank do not include law charges, printing and stationery, payment to employees, or interest expenditure. What do you mean by operating expenses? See, to run a bank, the bank has to incur certain expenses. Can bank run away from those expenses? Not at all. Bank has to incur certain expenses to keep itself alive. You know? So, what are those expenses, everyone, that the bank has to compulsorily incur? Always remember, the bank cannot run on its own now. Can a bank run on its own? The bank has to incur certain expenses to keep itself going. Right? And when they have to go through all those expenses, those are called operating. है ना? So the operating expenses includes law charges. Yeah, sometimes banks actually get into some legal troubles, or they have to fight cases against people when people claim. Then printing and stationery, payment to employees, or interest expenditure. Right? Okay, everyone. This, and this. Employees have to be paid to keep yourself running. Printing and stationery has to be paid. Without paying for the printing and stationery, can the banks work? Because they have so many documentations. Even though everything is now turned into the CBS working there, but still there is a lot of filing work and extra, etc., which is required to be done by the bank. So I can say in this case, these three are expenses. But interest expense, we pay to the people now. This is finance expense or operating? This is not something that I can say this is a finance operating expense, because this is not to run a business. This is the core working area. You are spending so that you can earn more. This is the core area. That is why interest expenditure is not a part of operating expenditure. It has got its own respect when it comes to the books of accounts. Now, it has its own respect. Acha, next question. Interest earned by the bank is shown under which schedule of the profit and loss account? This portion is related to the area of income and expenditure, everyone. Interest earned by the bank. This is the primary source of earnings for a bank. Not anymore now. Now the banks also earn through the treasury management. They buy and sell securities. They are also involved in agency services as well. So I can say that the banks are not surviving on only one source of income, but they are surviving and thriving. Not only surviving. I'm sorry. The banks are surviving and thriving and growing through multiple sources of income now. But one of the basic source of income is Schedule 13, 14, 15 or 16. Interest earned is one of the primary sources from which they make money. So in this case, the correct answer is going to be schedule number 13. As per the financial statements of a bank. What I can do is in the next class, I'll show you a glimpse of what exactly the financial statements of a bank looks like. Okay. so that we can actually relate to the entire area. What's it? In the next class, I'll do that. Acha, now it's already good number of days have already passed. So I hope your preparation is going on at the full swing, right? Chali. Then let's move on and talk about the next portion. What is the primary source of revenue for a banking company? Since we were talking about the multiple areas, what is the primary source? The primary source can be interest on loans, commission and fees, dividend income, or capital gains. Banks earn through multiple sources, but the fact still remains is everything else, the commission and fees that they earn, dividend income, this happened after interest. The banks were basically formed to accept deposits and to provide loans. And they were making money through the interest differences. They would charge more interest and they will pay less. And the difference between that will help you to run the bank, that will help the bank to grow further. Now the banks are involved in service agency work, I would say. For example, they have started doing the insurance work. Now the banks are also involved in maintaining our demat accounts. Banks have their own treasury management work where they buy and sell securities to get money out of it. So there are so many ways through which the banks are earning right now. Na? They're not restricted to one particular thing anymore. है ना? Next point. Which of the following is not a liability for a banking company? Customer deposits, loan and advances, borrowing from other banks, or share capital? What will it be? For a bank, what is not a liability? If they have given loans to someone, then they'll be happy. They'll be like, Array, I have to get money from someone. Huh? The person doesn't have to pay us. The person has to pay to us. We don't have to give anything to them. Customer deposits means we have to give them interest. The banks are bound for that. Same thing goes for loans and advance, borrowing from other banks. If you have taken money from other banks, you will have to pay interest. Share capital, the owners are going to ask us that, Hachi, are you giving me the dividend? So in all the areas, these are all three areas of liabilities, clear liabilities of an organization. But when you talk about loans and advances, bank has given money to someone else. So bank is going to tell about that they will receive money. This is a source of income for the bank. What is the purpose of the cash flow statement in the final accounts? To show how the cash and cash equivalent have changed over the period. To provide details about customer deposits, to calculate the interest earned, or to summarize the income and expense of the company. Why do we prepare the cash flow statement? I would say how the things, money and the other different forms of money, cash and cash equivalents, how do they change over the period of time? The basic working is this only. What we had in the beginning, how much of cash are we having at this point of time? See, at any point of time, anybody can ask me, Haji, how much money do you have? I should be having enough in my pocket so that I can pay it off, na? That's why. So, this is the end of the particular session. But before I end the particular session, flow, fund flow in detail again, along with the part of the banking companies. Okay. So basically, it's going to be a mix of two chapters of our book, Module B. Okay, so let's begin with it. Here comes the first question, everyone. Among the following, which one is not a fund flow of the firm? Depreciation, dividends, interest payments, and taxes. Okay. When we talk about dividends, it's an outflow. You know, they're giving dividends, or maybe we'll be receiving dividends. Interest payments, it's an outflow. Taxes, it's an outflow. So these things are sorted. That there is a flow of money. It may be today, it may be tomorrow, but the flow of at least the fund is there. But in terms of depreciation, do we give it to anybody? I just bought this particular digital pen tab for the classes there. Now its value is declining because every single day new things are coming up. Am I paying the depreciation of it to anybody? I'm using it every day. I'm earning through it. But am I giving it to anybody else? No, I'm not giving it to anybody else. So can I say this would be the depreciation for me would be a non-cash expense? Though it's an operating expense, it is used in the business, but then it's going to be a non-operating or non-cash. It's going to be non-cash because there is no movement of cash. Okay? So correct is no, the depreciation. In both cash flow and fund flow, we do not include the area of depreciation at all. Share premium, share forfeited, profit and loss account, balance of profit are examples of current assets, permanent liabilities, fixed assets, current liabilities. अच्छा, share premium मतलब if I talk about shares, if I buy shares from you, I've bought shares from you, and if I've bought shares from you, then अच्छा नहीं, I'm issuing shares to you. I'm issuing shares, the face value of those shares is 10 rupees and the share of 10 rupees is given for 12 rupees. This is share premium. Share forfeited means the person said that I cannot pay you anymore, or he doesn't respond at all, and the remaining amount is not given to by him, and then whatever he has given, we keep it with us. Then profit and loss account, it talks about the profit or loss the organization would have got in terms of surplus and everything they have kept with them. Balance of the profit there. These are what? These all things are a part of current assets, permanent liabilities, fixed assets, or current liabilities. Remember, these things are going to be there in the organization. They're a part of share capital. And share capital is the soul of the organization. That's the fact about it. It's the soul of the organization. So in this case, the correct answer is permanent liabilities. Next point, which of the following statements is correct? A decrease in current liability during the year results in increase in working capital. Only the cash expense are added to net profit. To find out the funds from operations, conversion of debentures into equity shares appear in the fund flow, or collection of debtors is a source of funds. Achha. Which one's correct, everyone? Matlab, okay, everyone, there is one point which I could see directly. Rest everything just becomes confusing. The last point says the collection of debtors is a source of funds. I get money from them, isn't it? Debtor is whom? Debtor is the person from whom I am going to get money. The moment I get money, the fund is received, he is free from being my debtor. In this case, this one is the only thing that would be correct. No, this would be correct too. A debtor collection of debtor is a source of funds. It is a source of funds. A decrease in current liability during the year results in increase in working capital. This is also true. See, the point is CA minus CL. No, I got the point why this is not included. Let me tell you. The correct answer would be A only. CA minus CL is equal to working capital. If this falls, automatically your working capital will rise because this is a negative term and this is a positive term. So they will have an inverse relationship. That's sorted. Collection of debtors is a source of funds. In this case, I receive cash from a debtor. In this case, both are current assets. So if there is a movement from one current asset to no current asset, this results in no flow. If one thing is current, be it current asset or a current liability, and one thing is non-current. That is non-current asset and non-current liability. Okay. Okay. I hope it's visible right now. So it's going to be non-current asset or non-current liability. The rule of fund flow clearly says, the correct answer is A only. The rule of fund flow says that if you have a current asset and current liability, non-current asset and non-current liability. In this case, if one current asset and one current liability, for example, I paid my creditor, so I'm paying in cash, so my creditor is gone and the cash is gone. When the transaction relates to this is working capital, everyone. The capital which is required by the firm for their daily day-to-day working, day-to-day operations of the organization, this is what is required. So this is CA and CL, and that is called working capital. Once we know about the working capital, then there are something, the assets which are used for more than 1 year are called non-current assets. And when we are purchasing, for example, I purchased an asset and I paid in cash. This is fund flow. One thing is current and one thing is non-current. Okay? And one thing that can happen is I paid off a loan, term loan. This is also fund flow. If I got an asset and I gave, I bought a machinery and I paid in shares. This is also fund flow. So can you see, one thing should be current and one thing should be non-current. If one non-current thing and a current thing is involved, it will always turn out to be something which is called fund flow. Here, if these two are happening, everyone marking it again. If the working capital, this part CA converted into a CL and non-current asset converted into a non-current liability. When such a thing is happening, these two and these two, they are not a part of fund flow. If one thing is non and one is current only and only, then we will consider it as current. Okay, here comes the next question. A company reported current year profit as 70,000. After the following adjustment, loss on sale of asset is 9,000. Premium on debenture is 1,500. Tax provision is there. Dividend income is there. Profit on valuation of asset is there. And the amount of fund from operations will be. They're looking forward to the fund flow, cash flow. Sorry, we are looking at the fund flow from operations. Huh? So this is fund flow from operations. No. When we are talking about operations, this will go into the area of, this is a question of cash flow, everyone. In fund flow, you have only two statements. Achha. Let me just tell you how to actually differentiate between the two. In fund flow, you will have working capital statement, which is CA and CL, while the cash flow is current. After this, they prepare sources and application of fund. They prepare two accounts. Okay? Source and application of funds, and one is working capital statement. Statement of changes in working capital is the exact name for that. While in terms of cash flow statement, they divide the entire portion into three activities: operating, investing, and financing. Okay? Done? Done, everyone? So in this case, when we are looking at the things, this is a question of cash flow, not fund flow. If we have a loss on sale of equipment, this has to be eliminated because this is not a part of the cash flow. It has to be removed. Only the receipts and payments are taken, that too in investing activity. While we are finding out things as per operating, whatever is my hardcore business. Premium on redemption is something that we pay. So this would have been a minus. So I'll be cancelling it by adding it. Tax provision, this is as such allowed, but first of all, we add it back. Because I said pata hai, I have to pay 10,000. The actual amount is important. The provision is not. So whatever the provision is, we'll be adding it back. Dividend income. We have received an income, but the point is this income is relating to the investments, not my business. Till the time the question didn't say that this is my hardcore work that I do the trading part, then the story would have been different. So this is a minus. Profit on revaluation of fixed assets. This is something, the profit is not received. I have this pen. Today I'm just talking to you and say this is pen worth rupees 2,000. Tomorrow I say this is rupees 3,000. There is no money incoming to me. There is no money going out of my account. So in this case, this has to be eliminated. So you'll have to add 1, 2 and 3 and you have to deduct these two. This will give you the answer. The answer would be 70,000 plus 9,000 plus 1,500 plus 22,000 minus 4,000 and minus 2,500. It comes out to be 96,000. The correct answer is 96,000. Done, everyone? This is a question from the area of cash flow, and that too a practical question. Which of the following statement is not true? Fund flow statement is also known as a statement of sources and application of funds. It is called that. So this is true. Fund is equal to current assets minus current liabilities. No, that is working capital. There is an inverse relationship between current assets and working capital. No, there is a direct relationship between the two. Fund flow statement is prepared on accrual basis. That is also true. So in this case, I can see two things. As such, we can still go for B because up to an extent, working capital is a part of fund. Okay. So the point that would be wrong is which is not true. Which this has to be which is true. This one is true. There is an inverse relationship between current assets and working capital. This is wrong. This is completely wrong. The answer is C, not D, everyone. Let me correct there. The correct answer is D. Let me just correct it for you. There is a direct relationship between current assets and current working capital. Okay? Because what happens is, let me tell you how it works. If I say my current assets are of rupees 10,000, my current liabilities are of 5,000 rupees, and now it turns out to be 5,000 rupees. If my current assets will increase to 12,000 minus 5,000, as soon as my current assets are increasing, my working capital or my fund is also increasing. So CA minus CL increases if this working capital increases when current assets are increasing. So in this area, the concept is completely falling apart. Okay? There's an inverse relationship between current assets and working capital. This is wrong. Current liabilities and working capital would have been fine. That is true. Next point, which of the following results in decrease in working capital? Goods sold on credit, decrease in current liabilities, decrease in current assets, or increase in current assets. Obviously, when we look at increase in current assets, we'll always increase in current in working capital. The relationship between working capital and current assets is a positive one. So in this case, if the current assets are falling, the working capital will also fall. So the correct answer comes out to be decrease in current assets. Done, everyone? Next point. While calculating the cash flow from operating activities which is added to net profit, increase in stock, decrease in stock, increase in debtors, or decrease in creditors. Which calculating cash flow from operating activities, which is while calculating आएगा यहाँ पर ना, ठीक है? This is going to be while calculating the cash flow statement which is added to NP. NP, अच्छा everyone, Both cash flow and fund flow have one thing in common. They also connect the area of working capital. See, if I buy a current asset, if I buy, I lose money. So increase in CL is increase in CA is basically a outflow of cash. An outflow of cash will be negative. So one thing is sorted. Okay. What then they are asking what is added? If I sell an asset, everyone, that will give me money now. So if there is a fall in CA, decrease in stock, I can say there is a sale. Increase in debtors means I've given more money to someone. Decrease in creditors means I've paid to them. What is it that will increase my net profit? You know? The net profit is basically if we are decreasing the stock. More and more stock is sold, our profit is increasing. More and more money is coming into our hands. And inflow in cash flow statement is always a plus. And outflow in cash flow statement is always a minus. Done, everyone? Depreciation is added back to the net profit while calculating cash flow from operating activities. Depreciation is a non-cash expense. It is reduced to net profit. There is no cash flow. Both assertion and reasoning are true. Reasoning is correct or explanation is assertion is correct. Just focus upon this part. I think let's put at D nota. None of the above. Depreciation is added back to NP while calculating the cash flow. That is true because it's a non-cash expense. But depreciation is a non-cash expense. It had reduced the net profit while there is no cash flow. So I think I'll go for both the correct points. No, the answer is C only. C भी नहीं होगा इसका. That is depreciation is a non-cash expense. It had reduced the net profit while there is no cash flow. This is also true. Whatever your net profit was, this was after depreciation. So it had reduced the value of net profit. While cash net profit is already there, na? So we add it back. So I think both of these are correct. So let me just correct the question there for you. चलिए. Then the last point is the so in this case the correct answer is going to be A. Okay? The correct answer is A. Both are correct. Net profit adds back the area of depreciation because it's a non-cash expense. Okay, na? Good morning, everyone. Welcome to Office Adda 24/7. My name is Niharika Valia Bhatnagar and I am with you with the area of accounting and financial management. What are we going to talk about today? Everyone, I am done with the module A altogether. I am done with a lot of parts of module B altogether. Now we'll be proceeding towards the module C from tomorrow onwards, right? That means on Monday onwards, right? We have a series going on now. So on Monday onwards, we'll be starting with this particular session to be conducted like that. So let's begin with the session today. First is cash flow statement and ratio analysis. JIB November 2023, we are looking forward towards CFS as well as ratios because today I'm going to take a part of CFS as well as ratios. Okay, here comes the first question. The first question says, accounting ratios helps in what? Inter-firm comparison, intra-firm comparison, comparison with industry norms, or all of the above. What does it exactly do? Accounting ratios are basically relationships between two or more type of numeric items. It is basically nothing but numeric items. The numeric items which are going to have a particular relationship, there can be any kind of relationship. That is what they call it as accounting ratios. Relationships between two or more items of the balance sheet or the financial statements. What does it do? Does it help in inter-firm comparison? Yeah, you can compare two different firms of the same industry. Then intra-firm, within the firm, we are looking forward to what happened with the previous year, what is happening in the current year. Then we have the comparison with industry norms. See, the industry altogether itself is growing and we are going at a faster pace. That is a good thing. If altogether the industry is growing and we are not able to grab the opportunities, this is where we need to know where we are exactly standing in the industry, isn't it? This is an important area to look forward to, है ना? So in this case, it is all of the above. Done. Next point. DSCR. But this is one of the most important ratios that I've seen even in the bank promotion examinations as well. Not only in your examination, but also an examination which is related to your career there. So when we talk about DSCR, debt service coverage ratio, the full form is debt service coverage ratio. This is all ratios, everyone. There are many questions that I take from IIBF book as well, so that anybody who hasn't been following the IIBF book yet, or they are having any confusions regarding the questions and all, we are discussing it in the class itself. Other questions are also there. I'm covering up the IIBF material as well, so that you are able to cover everything, be it in the YT sessions, be it in the paid sessions. In the paid sessions, we definitely look forward towards more deeper analysis of these things. But in the YT sessions, we are covering those things, but from the point of view of MCQs. Debt service ratio talks about, see, the point is, there are certain compulsory payments. There are certain payments which are compulsory payments for the organization. If you have taken a loan, you cannot cry that you don't have money. You will have to make the payment. So debt service coverage ratio is used for which of the following? Judging the margin of safety before this fault in repaying the loan, judging whether the firm has borrowings disproportionate to the net worth, judging the capacity of the firm to service the interest on debt, or all of the above. What's the correct answer? Debt service coverage ratio talks about the financial health of the organization. Are they really able to pay back the certain amounts? Are they making any defaults in those amounts or not? That is another important point. So in this case, the correct answer would be, they're talking about their solvency. We're talking about the certainty in terms of their solvency. So in this case, the correct answer would be judging the margin of safety available before there is a default in repaying the loan. Okay? That's the correct answer. Which one of the following is true? Both EPS and PE ratio vary with stock market price of the company's share. While calculating debt equity ratio, fixed deposits from shareholders are taken as a part of debt. While calculating quick ratio, all current liabilities are not taken into account. Then debtor turnover ratio is the higher if the company sells more goods on credit basis than on cash basis. Okay, let's look at both EPS and PE ratio. EPS is earning per share, while PE ratio is price earning ratio. Where we have market price divided by earning per share. With the stock price of the vary with the stock price. Okay, when the stock price changes, then EPS is something which is related to the area of profit. It is not related to this area. So I think this part is definitely wrong. Earning per share is related to the net profit after payments of debenture holders, preference shares, whatever is left divided by number of equity shares. So in this case, we are not doing anything else. While calculating debt equity ratio, fixed deposits from shareholders are taken as a part of debt. While calculating debt equity ratio, fixed deposits from shareholders. Yeah, that's a form of debt as such. It is, because whatever money we have taken from others, we are bound to pay it back. So this one is correct. Till now, this one's wrong. This one seems correct. While calculating quick ratio, all the current liabilities are not taken into account. Quick ratio is basically current assets upon current liabilities, where current from the total current assets we are removing stock or inventory and prepaid expenses. Both have been removed, and that is what we are left with. That is, we are left with quick assets divided by current liabilities. In this case, quick ratio has the is basically including all the current liabilities. So this one's wrong again. Debtor turnover ratio is higher. Debtor turnover ratio talks about in how much time the people are paying us. The debtors are paying us. It has nothing to do with the cash basis or something. Debtor turnover ratio talks about your net credit sales divided by your average debtors plus average BRs. In this case, where are they talking about cash basis? No talk about the cash basis, no talk about the total sales. They're just talking about in how much time people are paying us back. Isn't it? If this is about how much time people are paying us back, then it simply means we have nothing to do with their amounts. So this is the point. D is definitely incorrect. So there is only one point which is correct, that is B. Okay? They are someone who to whom the organization is supposed to pay back. Which one of the following is true? Higher debt equity ratio increases the profit margin of the company. Debt equity ratio is an indicator of solvency. A high current ratio is always an indicator of efficient management. And depreciation is not an expense and should be excluded while calculating profitability ratios. Depreciation is an expense which helps in reducing the tax. How can we exclude it? वो तो पाप है. It's wrong to do that. It's a sin. Okay? It turns out to be a sin. Oh, I'm sorry. Since the answer is visible, high current ratio is always an indicator of efficient management. No. If I'm having too much cash, the very first thing that will be asked from me is, why isn't this cash invested somewhere else if this money was not required? If it was not required, it should not be with you. So this is also wrong. A high debt equity ratio increases the profit margin of the company. Yeah. Debt equity ratio, nahi. Debt eats away your interest. So interest is basically something that reduces your profit. So this is also not true. Debt equity ratio is a an indicator of solvency. In actual, it's basically an indicator of long-term solvency, not short-term. For short-term, we have current ratios. If I ask you money today, that do you have money today, and you say yes, that means you are having short-term liquidity. If I ask you that after 5 years, can you pay me back, and you're like, yes, I can pay you back, that is long-term solvency. है ना? And anything which is beyond 1 year is considered as long-term. That's the rule. Next point. Which one of the following statements is correct about fixed asset ratio? Fixed asset ratio is basically asset ratio of fixed assets and net worth. Fixed assets and long-term funds, a ratio of less than 1 indicates the short-term resources have been diverted for long-term, or none of the above statements are correct. Fixed asset ratio is basically knowing what is the amount of long-term funds that are invested and what is the amount of fixed assets that we have invested. See, to buy a fixed asset, I will have to have a long-term loan, not short-term. Okay, to build a house, how much money would I need? Maybe at this point of time, to build a house, I need at least 50 lakhs. You know, if my plot is big and I need around 50 lakhs to build up that place. So shall I take a bank OD or CC for that? Will it be correct? Those are working capital based loans, not long term. They're not short term. The point is you have to make the payment over the period of time. The place will be built up and you will earn the money and then you will slowly pay it off. So this is totally a wrong concept altogether. So this is basically, if you have a long-term fixed assets, for those long-term assets we should have long-term funds. This is overall long-term funds. How much money is invested, be it shares or be it debentures or debt. I would say both equity and debt are involved in this. Okay, na? To build up the business, we'll have to look forward to all these things. Na? That is what is included in this area. Next point, everyone. There is a current ratio of 3:4, current liabilities of 24,000. What is the value of current assets? Okay, let's look at this. It is 3/4 is equal to CA upon CL. That's the formula of current liabilities and current assets. This is the formula for current ratio, and they've given the ratio already. So it's like 3/4 is equal to current assets is something that I don't know about, while the current liabilities are of 24,000. So it turns out to be 3 multiplied by 24,000 divided by 4. And this comes out to be 18,000. These questions are super easy if you remember the formulas. If you don't know about the formulas, this is where you lose the important points. Okay, that's the basic rule, everyone. Done? Acha, tomorrow we are coming up with our sale as well. Sorry, tomorrow we are actually releasing our AFM book, right? Then whatever we are extra coming up with it, the complimentary points are still unknown to me, and I think even to you right now. So I think let's wait and watch till tomorrow, right? So we'll have to wait till 15th of September and till 8 p.m. So we'll be having our AFM book launch on that particular day. So please make sure that you are a part of this particular important event. And if you are looking forward to buying the physical book, then hurry up. That book would be available from tomorrow onwards. And if you're looking forward to it, then go ahead and buy it before the offer ends and the stock goes out. Okay. So this is the point. What's the correct answer in this case, everyone? The correct answer is 18,000. As I told you, in these questions, there is nothing. The calculation is almost negligible. But the point where we face problems is where the main area of facing problems is only and only one, that is in these kind of questions, when they are doing it, you tend to forget the formulas. There are so many formulas that people tend to make mistakes in the formula area. That is where they find it difficult. Okay, na? Okay, now let's move on to the next point. We are given current assets of rupees 5 lakh, current liabilities are given, as well as revenue from operations. That is, our sales is also given to us. And they are asking about the working capital turnover ratios. Working capital turnover ratio is basically RFO divided by working capital. Turnover ratio simply means you are connecting to the area of turnover. So in this case, when we are calculating the question, it goes like we have turnover or RFO here at the top, or the numerator side, it is 28 lakhs. And what do you mean by working capital? Working capital is day-to-day working. The lights are on, the fan is working, AC is working, and then electricity is going on. Then we are also using water, है ना? Those basic things are required. Then I need someone to clean the particular area as well. There's a cleaner required, there's a helper required. So many things are required. This is basically something which I call the money which is required for day-to-day working. It is working capital. That is CA minus CL. It is 28 lakhs divided by current assets is what? 5 lakhs. And current liabilities is what? 1 lakh. This is your working capital. So this turns out to be 4 lakh. So that is 28 lakh divided by 4 lakh. So this turns out to be 7 times. Always remember all the turnover ratios. Turnover ratios talks about how many times that particular thing is in respect of the other. In this case, can we say WCTR means that what is the amount of operating capital or the working capital which is required in order to look forward towards our revenue. Out of revenue, which particular amount is always involved in working capital? Because a certain amount is always required, because we have to pay for the day-to-day things now. Without paying for the day-to-day things will not work out. We'll have to pay. Done? So in this case, the correct answer is 7 times. All the turnover ratios are expressed in times. Okay? Another question. The ratio of net sales to net working capital is liquidity ratio, profitability ratio, working capital turnover ratio, or none of the above. Ratio of net sales to working capital. Net sales is RFO to working capital. We have just done this same formula, everyone. Net sales is called RFO. Net sales simply means sales minus sales return. So the correct answer turns out to be working capital turnover ratios. Remember, all the turnover ratios either have sales as their main point, okay? Either they have sales or either they have COGS, cost of goods sold, as their numerator. And all of them are expressed in times. Hardly two, three ratios are there where the numerator is not sales or COGS. Otherwise, as expressed in their type only, they are connected with the turnover of the organization. Turnover means the sales of the organization. Okay? So these are called turnover or activity turnover ratios. Okay, another question. Cash and bank balance is 20,000. Account receivable, this is also current asset. And inventory is 2,80,000. These three are total current assets. The assets which are required within the 1 year. Then current liabilities, account payables 1 lakh. Bills payable 50,000. In this case, what is it that I'm getting? I am having 20,000 plus 2 lakh plus 2,80,000 rupees. A total of 5 lakh rupees is what? These are my current assets. A total of 1,50,000 rupees is my current liability according to the scenario, because we are supposed to pay to the liability to the people from whom we have taken money now. So within the period of 1 year, that is current liability. If the money is assumed, or basically it has to be materialized or received back within a period of less than 1 year, that is also a part of this. This is our current assets and this is our current liabilities. So the correct answer would be 5 lakh minus 1,50,000. This turns out to be rupees 3,50,000. The correct answer would be 3,50,000.